The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and happy Thursday. Welcome to Squawk Box Europe. I'm Juliana Tatelbaum with Carolyn Roth, and these are your headlines. Tesla shares skid in extended trade as CEO Elon Musk warns of fallout from expiring EV subsidies, while fresh data out of Europe shows a 40% slump in June sales.
Does that mean we could have a few rough quarters? Yeah, we probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2.
Deutsche Bank doubles its profit in the first half, hitting 5.3 billion euros on strong inflows to its private bank and asset management. CFO James Von Moltke tells CNBC he sees optimism around the state of the German economy.
There is a sense of confidence in Germany that's come back. And so that's a real change from the past several years where that hasn't been the case. And so, yes, we're seeing it certainly in client sentiment, probably the beginnings of investment decision.
Futures rise as the U.S. and EU edge closer to a trade deal, with negotiators reportedly nearing a 15% tariff pact, similar to President Trump's agreement with Japan.
A very good morning. Morning, Carolyn.
Good morning.
You picked a busy week to come join us in London. We've got so many earnings once again, and also another macro story driving trade with this EU-U.S. trade story gathering momentum. It looks like they're closing in on a 15% tariff deal.
Yeah, we saw the relief rally across risk assets in yesterday's trading session on the back of that U.S.-Japan deal. I will say, though, you heard me talking about it yesterday. I'm a bit of a skeptic here because, all this relief, but this is still a pretty bad number, Obviously, it's down from the threat of 30%, whatever. But, hey, this is not good news for many of the companies from the starting point where we were January, February. So I don't know. I guess moving the goalpost has led to a bit of a rally across the board.
You've got a very grounding view, Carolyn, that the anchoring effect is in full force here. Right. When it comes to how markets are interpreting this trade news. All
right, we also have some corporate news. Of course, as you heard in the headlines, Tesla shares sinking over 4% in extended trade as the electric car maker posted a 16% fall in auto revenue, the second straight quarterly decline. Shares stayed steady post the earnings release, but declined steadily throughout the earnings call as CEO Elon Musk and Tesla's CFO outlined their concerns over the cost of tariffs and the expiration of federal electric vehicle tax credits. Musk warned of potential further tough times ahead.
We're in this weird transition period where we will lose a lot of incentives in the U.S. There's a lot of incentives actually in many other parts of the world, but we'll lose them in the U.S. But we'll still be at the relatively early stages of autonomy. On the other hand, autonomy is most advanced and most available from a regulatory standpoint in the U.S. So, does that mean we could have a few rough quarters? Yeah, we probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2.
All right, for more analysis, of course, we've got our resident Tesla expert with us, Arjun. Of course, we know this company isn't necessarily an EV company anymore. It wants to reposition itself as an AI company, robo-taxi company, but we didn't get a whole lot of detail on that front in the call yesterday.
No, there's two types of investors in Tesla, Carolyn. There's the investors who see Tesla as a car company, and there's those who believe Elon Musk's vision about autonomy, about robotics, about AI. And on the call, we got the two sides of the story. EV business, not so good. Great future and excitement around autonomy, cybercab, and everything else. in between as well. But the market was very much focused on that EV story, and we saw a decline in deliveries, we saw a decline in auto revenue as well. And that's a big issue at this point for the company, because they're facing increased competition across all markets, particularly from the Chinese players and also some of the traditional automakers jumping into EVs. There hasn't been a new model on the market for some time, or a new sort of revolutionary new model. Now, one of the, I guess, points that the market's focused on is this affordable car that's been promised for some time, and that Tesla promises will come into mass production in the second half of the year. And the hope is that could reinvigorate some of these sales, a more affordable market to compete, particularly in markets like Europe, with some of these Chinese EVs as well. So interesting on that front. In terms of the future-looking stuff, the robotics, the autonomy, Elon Musk was talking about robo-taxis, and they are doing the trials out in Austin, Texas at the moment. And he said that they're planning to expand that and hope to serve half of the US population later this year. We know Elon Musk has a very big history of promising things that don't come true, so we have to wait and see if this is possible. He says it's technically possible, but we'll have to see in terms of the regulatory front, which of course is a big hurdle across multiple markets in the US and elsewhere.
In terms of more near-term guidance, clearly the long-term story here is very much hinged on how robo-taxis evolve and whether we do see this affordable version of the Tesla come to market. But on the more near-term, he said we probably could have a few rough quarters, not saying we will, but we could. And we just played that sound out from Elon Musk. What do you do with that guidance as an analyst, as an investor?
Yeah, and I think part of that stems from this scrapping of this $7,500 EV tax credit as part of the big, beautiful bill. Part of it also is around Tesla having to move supply chains around to deal with some of the tariff uncertainty. And you heard the CFO say that there's going to be a limited supply of Teslas in the US this quarter, and that they can't guarantee orders on Teslas made later in August and beyond as well. What was interesting was this note from Morningstar overnight, and they said they were talking about the guidance that we had initially heard, which was deliveries would grow in 2025, but they said that they interpret the no guidance given by management as a signal that they are no longer forecasting volume growth. So it's sort of a bit reading between the lines in terms of guidance. I think a lot of people aren't expecting those deliveries to grow this year, and perhaps reading into that tough quarter ahead statement as well from Elon Musk.
To what extent is his fallout, Elon Musk's fallout with Trump, going to hurt him? To what extent does it even matter still when it comes to future regulatory approvals?
Yeah, I think, look, the involvement in politics has no doubt hurt the Tesla brand. It's hurt the Elon Musk brand in a lot of markets, particularly, again, here in Europe. You have seen a visible impact from that. There are a lot of investors, a lot of analysts. We've heard Dan Ives, who comes on the channel, talking and saying that Elon Musk should just get out of politics. He shouldn't be in it. Should focus, be laser focused on all these businesses he has, from Tesla to XAI, and all of these big projects he wants to do. And so that is, I think, what a lot of shareholders are yearning for. Elon Musk to put aside the politics, to just focus on all these investments in AI in particular, in Tesla, but also at XAI. And he spoke to kind of both of those projects, saying that Tesla's all about real world AI, driverless cars, etc. And XAI is about super intelligence and artificial general intelligence. And so I think that's really what shareholders want to see, that laser focus and sort of wartime CEO mode from Elon Musk.
Arjun, let's add another voice to this discussion. Meanwhile, European car registration data from the ACEA out earlier this morning showed Tesla sales sinking 40% in the month of June, underlining the decline seen in deliveries for the electric vehicle maker. Steve Wesley is founder of the Wesley Group and, of course, also a former Tesla board member. Steve, was there anything you liked in this set of numbers?
Look, it's a tough quarter for Tesla. Revenue down 12% year over year. Q2 revenues, $22.5 billion, on track for about $97 billion for the year. That's going to be another flat year. Earnings per share down 23% in Q2. Well, global EV sales are growing double digits. So the punchline, it's tough for a hot tech company to sell a flat growth story. So Tesla needs cheaper models, wins on full self-driving ASAP. Let's see if they can do it.
Steve, obviously a lot of the brand equity has been destroyed over the last 6 months, given Elon Musk's political involvement here and meddling specifically when it comes to some of the European markets. How much of that can actually be recouped, or is that just burned?
Well, look, it doesn't help. But Tesla needs to do three things here to get back on track. First, they need a $25,000 model ASAP to compete with the Chinese, Volkswagen, Hyundai, and all the others, especially in the developing market where you have to show up with a $20,000 to $25,000 car. Second, they've got to get regulatory approval for robo-taxi in multiple cities ASAP. Third, as you point out, they need a new brand, less politics, more new products, lower prices. Big news today, Musk said a new low-cost car is coming in 2025. Big questions are, how low is the cost going to be? And when in 2025 is it going to come? Everybody's going to be watching that one.
Yeah, Steve, I just wanted to ask about that low-cost vehicle. It's been promised for some time. What do you think is the potential of such a car to kind of compete with, I guess, what the Chinese manufacturers are doing, particularly in markets like Europe, but also to allow Tesla to enter some of the new markets? We know it's recently launched in India as well.
Yeah. Well, look, here's what everybody's doing. All the legacy automakers, Volkswagen, Toyota, they're all partnering with Chinese entities to bring that $20,000 to $25,000 car to market. They're all watching BYD. BYD is growing faster than any other auto company in the world today, but they're doing it by attacking the developing world. They've got manufacturing facilities in Cambodia, in Indonesia, in Brazil, now in Hungary and Turkey in Europe. And the rest of the world needs to match that price point. So what I think Tesla may be about to do is take a really skinny down Model Y chassis, try to bring it to market at $35,000. I'm not sure that's going to fly. I think you have to be down in that magic 20 to 25K number. By the way, it's not as hard as it used to be. There's a revolution in batteries. By moving from lithium ion to iron phosphate, that's what the Chinese are doing. That's what Tesla and others are going to have to follow. But you've got to get down to that lower price point.
And Steve, Elon Musk said the big differentiator for Tesla is its sort of investments in AI and autonomy and full self-driving. But actually, we are seeing a lot of the Chinese players investing in a lot of these technologies in China and trying to bring that to international markets as well. One note this morning called Tesla a low moat kind of company when once it was, you know, one of the sort of leading players in EVs. How do you sort of see that Tesla story in terms of its moat now as competition continues to build?
Well, I think low moat is a fair critique. Tesla's got to kick this into a higher gear. They used to own the EV market. And the fact is, the Chinese are coming with multiple strong brands. They're coming out with autonomous vehicles as well. Pony AI, Baidu, WeRide. There's a lot of tough competitors. But the big issue, Tesla's got to beat Waymo in the U.S. first. And they've got to get regulatory approval, again, in multiple cities. Waymo already in San Francisco, LA, Phoenix, Austin, Atlanta, expanding quickly into DC, Miami, and next year, they're talking about New York City and Tokyo. They're already going global. Tesla's got to get successful launches with unmanned robo-taxis, not just in Austin, San Francisco, but ASAP, and roll out quickly from there. They're a ways behind, and they need some catching up.
Steve, when it comes to catching up on robo-taxis, it feels like this is probably the single biggest challenge for them when it comes to reinvigorating the growth story. Certainly when you look at analyst forecasts and the investment case surrounding Tesla. How urgent is this issue? And is there an inflection point where they're not going to be able to catch up to Waymo, given how far ahead they are and what this first mover advantage could mean for them?
So you've touched on the key point there. Tesla has come out and said, don't invest in us as a car company, invest in us as a technology company. Fair enough. Tesla's got a PE ratio of about 171. NVIDIA is down at like 55. It's almost a 3-to-1 ratio. If you're in that sort of nosebleed evaluation territory, you've got to deliver. Right now, Tesla is behind Waymo. They've got to get regulatory approval in multiple cities. They've got to start growing quickly. They're behind, and they've got a lot of catching up to do if they're going to hold on to that market valuation. Now, Musk appears to be, for the moment, out of politics, back focused on Tesla. We'll see if he can bring some of the brilliance he showed in 21, 22, 23 to the next half of this decade. But there again is some catching up to do.
Steve, thank you so much for sharing your insights with us. Steve Wesley, founder of the Wesley Group and former Tesla board member. President Trump has suggested that the baseline for tariffs with any country will be 15%, having previously announced 10% as the minimum level. It comes amid reports the U.S. and EU are closing in on a trade deal that would see the bloc hit with 15% duties, with the source telling CNBC some exemptions are yet to be worked out. The source added that the final decision rests in the hands of President Trump. Let's take a look at European futures and what's in store for trade this morning. We're about 45 minutes away from the market open. Strong gains indicated at this stage. The CAC 40 looking to add about 1.5%, the DAX 1.3%, and the FTSE MIB about 1.4%. This follows a more than 1% gain for the Stock 600 yesterday. Now, it is not just the trade deal in focus. Of course, earnings sharply in focus as well. Roche, the pharma giant, backing its full year guidance after posting sales of 30.9 billion Swiss francs in the first half of the year. That's up 7% on a constant currency basis and in line with analyst expectations as growth in sales of key drugs boosted its pharmaceuticals division. Well, we're very lucky to have Thomas Schinecker with us, CEO of Roche. Thomas, thank you for joining us this morning. Looks as though the pharmaceuticals business is doing quite well. Talk us through the growth drivers in the most recent quarter.
Yeah, thank you very much for having me today. Pharmaceuticals was growing very strongly in the first half of the year with 10% growth. In fact, we had an acceleration in the second quarter with 11%. And it's really the new and young portfolio that we have that is doing extremely well in breast cancer, in ophthalmology, food allergy, really across the board. And so we're very happy with those results. And in earnings, we did even better. If you look at EPS is up 12%.
The diagnostics division a bit more sluggish, and I think this won't come as a surprise given the challenges you're facing in China specifically, but just help us understand what's happening in diagnostics and what we can expect for the second half of the year.
So in diagnostics, there were healthcare pricing reforms in China that impacted the entire industry at the end of last year. And that means that if you look at diagnostics with the flat growth that we've shown, actually without that, diagnostics was growing 6% and continues to do very, very well. And we expect that growth to come back after this one-time effect will have washed out.
Thomas, this is Carolyn in London. Great to speak to you once again. Now, let's talk about the elephant in the room here. And of course, those are U.S. tariffs on pharma. It could be as high as 200%. Now, we understand that Switzerland and the U.S. are close to signing a trade deal. Would that shield you from any pharma tariffs? A lot of uncertainty surrounding that. What are you hearing?
Yeah, we're in close exchange both with the U.S. administration and also with the Swiss government. So I hope that there will be an agreement in the next couple of days. I think those negotiations are going well. Now, when it comes to tariffs, specifically to us as a company, I think we're in a much better situation than many other pharma companies. First of all, we have 13 manufacturing sites already in the United States, and we have some free capacity because of the innovation that we've done in our processes. So we have up to 50% additional capacity, and we have ramped up manufacturing from a number of key medicines already in the United States. And there's only one medicine where we had to do a tech transfer. And we hope that we'll finalize that by the end of the year. And we're in discussions with regulatory bodies to make sure that this medicine and this site is then also approved for delivering medicines to the US patients. So overall, I think we've done all we can, and we are well prepared for anything that may come our way.
Thomas, you're saying you've done everything you can, including a pledge of another $50 billion in investment in the country that you made back in April. We're seeing this charm offensive being undertaken by all the European pharma companies. And I'm wondering, is that being seen by Washington?
Absolutely. I think as an industry, we have pledged a significant amount of investment, close to $1 trillion US. And this is absolutely seen by the US government. And with that, we're creating jobs in the United States. And it is our goal to produce more products in the United States than the United States actually needs on its own. And we're on a good way to do that. In fact, in diagnostics, this is already the case today.
Thomas, let me ask you about some trial results that came through a couple of days ago around one of your key lung drugs that failed a late-stage trial. Can you comment on these results and how much of a setback it is?
Yeah, in pharmaceutical innovation, only 1 out of 10 medicines actually makes it to patients. So when you really look for innovation, you also have to take certain risks. The study started many years ago, about 4 years ago. And in the meantime, we also saw competitive data in the same pathway just a couple of months ago. And that trial was also negative. So we knew that this would be a high risk, high reward trial. So with that, it was also in line with what unfortunately we expected given the competitor readout as well.
Thomas, the U.S. has always been such a lucrative market for any pharma company, as opposed to Europe, where price setting is very much different from the U.S. But now Donald Trump wants to lower medicine prices. Is that still a lucrative, a profitable market for you? And what does it do to your ability to innovate?
Yeah, in the United States, you have so-called middlemen or middlewomen, these PBMs that actually take 50% of the margin of medicines and actually have no contribution to innovation, so they don't take any risks. So if we want to lower prices in the United States, it's very easy. We go direct, and then the US government can save 50%, and the US patient can save 50%. Look, at the end of the day, it's important that innovation is rewarded. We're also contributing significantly to the US economy. And we do believe that the US sees that and wants to make sure that they keep investing in an industry that is clearly important for national security in the United States. And if they want to stay ahead of China, I think it's also important that they keep investing.
Thomas, quick word on the pipeline. How confident are you in what's coming up?
Yeah, we've done a lot over the last 2 or 3 years to bring in very exciting new molecules. And we are confident that in the timeframe of 2027 to 2030, we will have a number of very important key readouts that will continue to help our growth momentum. And until that time, as you can see in our results, we have a very strong on-market portfolio. And we have very, very little patent exposure over the next couple of years. So we're confident that we can continue a good growth momentum over the next years. And then we'll have a number of key readouts that will help us drive growth further into the next decade.
Always great to speak with you, Thomas. Thanks for taking the time. Thomas Schinecker, CEO of Roche.
And still coming up on the show, BNP Paribas beating quarterly profit forecasts. We'll take a closer look at the numbers and hear from the CFO next. Plus, the U.S. and EU are reportedly closing in on a trade deal. We'll discuss more details with Sylvia later this hour. And do not miss our interview with the Nokia CEO Justin Hotard, as the telco equipment maker confirms a miss on second quarter results. We'll speak to him in less than an hour's time. Let's get to more earnings. We told you it was going to be a very busy earnings day. BNP Paribas has confirmed its outlook after booking a rise in second quarter group revenue to 12.6 billion euros. The French lender says it expects revenue to accelerate in the second half of the year, driven by its commercial and personal banking business. Luckily, we've got Charlotte with us to take a look at the numbers. You spoke to the CFO as well. Kind of a mixed bag when it comes to the investment banking revenues, though.
Yes, absolutely. Even though it was a beat overall for the second quarter for BNP Paribas, looking at CIB, revenue was up 4%, so a bit slower of a growth compared to the first quarter. And certainly looking within CIB, that's where there's kind of a mixed bag. There are global markets there, the big focus on fixed income and commodities there was up 27% revenue, so a big change compared to the last quarter, while equities were down 15%. And they talk about the volatility not helping on that front. And looking at global banking, of course, with houses, advisory and M&A, they say they see a lot of clients in a wait and see mode because of the tariff uncertainty. And when I spoke to Lars Machenil, the CFO of BNP Paribas, he explained the performance in that division.
If you look at the first semester, it was a very strong result. Actually, if you look at, for example, the department itself, it has a record for the 6 months. It has a record top line. Yeah? And so if you look at it, first of all, if you look at FIC has a very strong quarter again. Both the demand in whatever, it's basically rates, but also a pickup in credit. So very solid. And we basically saw a 27% pickup compared to a year ago. And then you have equity and prime services. Equity and prime services still had a very good start of the year. If you look at the balance sheet usage, they are at very high levels. However, I remind you that a year ago, in the second quarter of 24, well, we called that all stars were aligned, and particularly in France. Remember, with all the announcement made towards the end of June, there was really a demand across all products in EPS, so equity and prime services. So basically, the base was very high in equity and prime services. And as I said, if you look at the intrinsics over the year, equity and prime services have been doing very well. But it's a base effect.
And so now BNP Paribas expect an acceleration in revenue for the second half of the year, especially driven by the commercial and personal banking that will benefit from the interest rate outlook. They see a better NII. And of course, you know that France, here again, it has a bit different to other banks. The mortgages are fixed for a really long time. The savings accounts are fixed on inflation. So now they see that rate of savings going lower by the Banque de France recently. So they will benefit from that change. That's interesting because you know that the BNP management focused on trading, that they focus on asset management, buying the unit from AXA, and now they're focusing on the domestic retail bank as well. So they see this part of the business potentially benefiting going forward. And then I talked to last March Neil about the overall trends in the sector and the question of M&A within Europe. And in his view, while cross-border is still complicated, say on the domestic front, there's no reason why they shouldn't happen.
On consolidation, there is a difference in Europe between cross-border and in-border. Yeah? Cross-border, we remain convinced that today it is very complex, not because of regulation, but just because the main difference, the products are so different, the synergies are very limited. Yeah? However, in-border, clearly there are economies to happen. And so there is intrinsically nothing that blocks those things from happening. So that is why, if you look at the regulatory environment, there is nothing that should stop it. I can understand that there can be local constraints, but intrinsically banking constraints, we don't see that many.